Hi, I am Sugandha Priya.
Hi, I'm Ritu Sharma.
Today we are here to explain the effect of the data released of non-farm payrolls, GDP, Chinese financial system and jobless claims on the prices of USD, copper, gold and crude oil. So let's start with non-farm payrolls. Non-farm payroll employment is a data which is released by the US Bureau of Labor Statistics on every month on the first Friday. This data states that how many jobs have been added or lost in the US economy over the last month. This data is a compiled report of the employment of the manufacturing companies, goods companies in the US. So the current data was released on September 2, 2016 for the month of August 2016. The data was 1,51,000 jobs were added in comparison to the expected data of 1,80,000 jobs. So there is a decrease in the expected data that was released. So what does that mean? That means that there will be, in the recent time, there will be no rate hike in the US economy. When there will be no rate hike in the US economy, that means the USD prices will go down. So there is a direct relationship. But when the commodities market will have an indirect relationship. That is why, because when the commodities market are very sensitive to interest rate hike, but there is no interest rate hike in the near future, and that is why there is an indirect relationship.
Moving on to a graph showing the NFP data for over 4 years from early 2012 to September 2, 2016, where the current data was released for the month of August 2016. As we can see that the current data released is 1,51,000 jobs, whereas the forecasted data was of 1,80,000 jobs. As we can see that the US economy added less jobs, so the prices of USD went down. But the prices of commodities varies indirectly with the NFP data, and so their prices went up. For example, gold went up by more than 1%, whereas metals went up by only 0.12%. But the biggest rise was seen in the crude oil, which went up by nearly 3% on 2nd September 2016.
Now, moving on to jobless claims. What is it? This data states that how many new people have filed for unemployment benefits in the last week. As this data is released weekly by the US Department of Labor on every Thursday, so this data is very volatile. So a 4-week moving average is monitored, and then see then how many data have been, what is the data released. So the current data was for the week was released on September 15, 2016, and which was like 2,55,000 people had submitted this file for unemployment benefits as expected to 2,60,000 people. So there is a less data have been found, and because of which there is an indirect relationship on the prices of USD. Moving on to gold, the prices of gold has a direct relationship when the jobless claims that are released. Because the data for the present week was less, so people will demand for more gold, and there would be a direct relationship. But for the other commodities market products such as copper and crude oil, there is an indirect relationship because there will be more employment, more people, production will be more in the economy, and so there will be indirect relationship.
Now let's see the graph that of a jobless claims data for a period of 5 years starting from 2012 to 2016. Here you can see that the highest peak is shown in 2013 when around 4,50,000 people had filed for unemployment benefit. But after this, there is a decreasing trend which has till now, and the current data, which was released on September 15, 2016, the data was of 2,60,000 people filing for unemployment benefits as compared to 2,65,000 people. So this means that there is more employment in the economy, and that is why we can say that as people have filed for less unemployment benefits, that means it has helped spur economic growth in the US economy. And also, as this data is taken for on a weekly basis, so we can see that like for the entire month from September 1 to September 15, that is for 2-3 weeks, the data, the expected data is higher than the actual data that has been released. So this is a good news for the US economy.
Now moving on to the gross domestic product and Chinese financial system, we will see that how they are being affecting the USD, gold, copper and crude oil. First we have to understand what is GDP. GDP is the monetary value of all the goods and services produced in a country in a specific time period. This data is released on quarterly and annual basis by the Bureau of Economic Analysis in USA. Since if we suppose the GDP of a country is growing, so then its currency is also growing, its industries are also growing, so it will be having a direct relationship with USD, copper and crude oil. But if we move on to gold, it has an indirect relationship, because if the GDP is growing, so people's savings are also growing and the industries are also growing. So the demand for gold is not so much, because people will be moving further for the gold and other industries and manufacturing. So as also we can understand from the USD and the gold has an indirect relationship, inverse relationship in both of them. So they will be having a indirect relationship between gold and USD. But moving on to the Chinese financial system. The Chinese financial system is highly regulated, but it has started to expand because China's banks are also coming, and China is a main exporter to other countries like USA and India, as we all know. And China, since it's a very a big major consumer and producer of gold, copper and crude oil, hence it has a direct relationship with the gold, copper and crude oil. But if we move on to USD, since China always pegged its currency yuan as compared to USD to have its exports moving on, that's why the relationship between USD and Chinese financial system cannot be concluded, cannot be decided.
Now, as we have seen the graph, as we have understood the relationship between GDP and USD, now we can understand this concept from the graphs. As we can see in this graph, the GDP of the USD is growing. The GDP of the USA is growing. We can easily identify that the prices of goods and services are increasing in USD. This also we can see from this graph also, the GDP is increasing, hence the prices of product and services are being increased, and it is impacting USD directly because the prices of goods and services are becoming more and more costlier for persons. And now we can see this graph for the relationship between GDP and gold prices. As we can see, the GDP is growing, so the gold prices are also coming down. But when we see that the gold prices are going up, the GDP is going down. So there is an inverse relationship, or we can say an indirect relationship between GDP and gold prices. Now we can see that GDP has a strong impact on oil prices. Like as the GDP is growing, the oil consumption of the USA is also growing. We can come to China's export. As we can see from this graph, China's exports are increasing, but they're not so much increased in the number in comparison to USD. In July 2016 it was 1847, and in August it was 1905. Now we can see that as the China exports are increasing, hence the demand of USD is also increasing. But as I told you that China is always pegged its currency, so it is not making much impact on USD. So the conclusion for the relationship between the USD and Chinese financial market cannot be concluded. Now we can see from this graph for the China's oil production and consumption. We can see that as the production of oil is increasing, same the consumption is also increasing. So we can say there is a direct impact of China's financial system on the consumption and the crude oil.
So today we have learned how non-farm payroll, jobless claims,
gross domestic product and Chinese financial system is affecting USD, gold, copper and crude oil. Thank you.